Preparing for a finance roles at Prudential Financial interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work in a finance role at Prudential Financial? Prudential appeals to me because finance directly supports financial security for individuals, institutions, and retirement customers. I am especially interested in combining rigorous analysis with decisions involving capital, risk, and long-term liabilities. The company's scale across insurance and asset management would let me learn how different businesses interact financially. I would bring strong modeling, accounting, and communication skills, while developing a deeper understanding of insurance economics and how disciplined finance strengthens both resilience and sustainable growth. While answering, connect your finance interests to Prudential's insurance, retirement, investment management, and risk businesses. Demonstrate research, explain the role's appeal, and show how your skills support long-term customer and shareholder value. Question 2. Walk me through the 3 financial statements and how they connect. The income statement measures revenue, expenses, and net income over a period. Net income flows into retained earnings on the balance sheet, while non-cash items and balance sheet changes explain operating cash flow. Investing and financing activities then reconcile beginning cash to ending cash. For an insurer, I would also pay close attention to investment assets, policyholder obligations, premiums, claims, and reserve movements. A strong analysis checks that all 3 statements tell a consistent economic story. Make sure to cover income statement profitability, balance sheet resources and obligations, cash flow movement, retained earnings, non-cash expenses, working capital, and the importance of reconciling beginning and ending cash. Question 3. How would you analyze an insurance company's profitability? I would separate insurance profitability into underwriting and investment performance. Underwriting analysis starts with premium growth, claims, expenses, and the combined ratio. Below 100% generally indicates underwriting profit. I would examine reserve adequacy and development because current earnings can be misleading if prior estimates change. Then I would assess investment income, asset quality, duration, and capital requirements. Finally, I would distinguish recurring results from catastrophe losses, market movements, or one-time transactions before forming a conclusion. In your answer, discuss underwriting results, investment income, premium growth, loss and expense ratios, combined ratio, reserve development, product mix, capital usage, and separating sustainable performance from market or catastrophe volatility. Question 4. What is the difference between statutory accounting and U.S. generally accepted accounting principles for an insurer? U.S. generally accepted accounting principles is designed primarily to inform investors about economic performance, while statutory accounting emphasizes policyholder protection and solvency. Statutory reporting can use more conservative asset recognition and liability treatment, with explicit capital and surplus considerations. Generally accepted accounting principles may better reflect earnings and financial position for shareholders, but statutory results determine regulatory capacity and dividend flexibility. In an interview, I would explain which framework the decision requires rather than treating one as universally superior. Be sure to mention statutory accounting's solvency and regulatory focus, more conservative valuation, admitted assets, required capital, generally accepted accounting principles as investor reporting purpose, and why both perspectives matter at Prudential. Question 5. Explain the insurance combined ratio and what it tells you. The combined ratio equals the loss ratio plus the expense ratio. It measures underwriting efficiency before investment income. A ratio below 100% indicates underwriting profit, while above 100% indicates an underwriting loss. I would not use it alone, because product mix, catastrophe exposure, reserve releases, and policy duration can distort comparisons. For a life-focused business, I would complement it with mortality, morbidity, lapse, spread, and expense metrics rather than forcing a property casualty framework onto every product. Focus on the loss ratio, expense ratio, combined ratio calculation, interpretation above or below 100%, limits of the metric, product differences, reserve development, and the role of investment income in overall profitability. Question 6. How do interest rates affect Prudential's insurance and retirement businesses? Interest rates affect both sides of an insurer's balance sheet. Higher rates can improve reinvestment yields and make annuities more attractive, but they may reduce the market value of existing bonds and pressure liabilities or policyholder behavior. Lower rates can support bond prices but compress spread income and make guaranteed products more expensive to support. I would analyze duration matching, credit spreads, hedging, surrender assumptions, and the timing of reinvestment rather than assuming rates have one universal effect. In your answer, cover asset yields, liability valuation, duration matching, spread income, annuity demand, policyholder behavior, unrealized gains and losses, and why the impact differs between rising and falling rate environments. Question 7. What is asset-liability management, and why is it important for an insurer? Asset-liability management aligns an insurer's investments with the timing, amount, and risk profile of policyholder obligations. I would compare asset and liability duration, expected cash flows, liquidity needs, and sensitivity to rates, spreads, mortality, and lapses. The objective is not simply to maximize yield. It is to earn an appropriate return while preserving the ability to pay claims under stress. Effective ALM therefore combines portfolio construction, derivatives, scenario analysis, and disciplined risk limits. Make sure to discuss matching asset cash flows with policyholder obligations, duration, liquidity, interest rate sensitivity, credit risk, reinvestment risk, stress testing, and balancing solvency protection against investment returns. Question 8. How would you evaluate the quality of an investment portfolio held by an insurance company? I would evaluate the portfolio through both return and resilience. Key factors include credit quality, issuer and sector concentration, duration, liquidity, spread compensation, impairments, and sensitivity to rates and defaults. I would also consider how each asset affects regulatory capital and whether its cash flows match policyholder obligations. For structured or private assets, I would review underwriting, valuation methodology, covenants, and transparency. A high yield is attractive only if the additional risk is understood, priced, and manageable. Discuss credit quality, concentration, duration, liquidity, sector exposure, impairments, yield, capital charges, issuer diversification, structured assets, and whether portfolio risk appropriately matches policyholder obligations. Question 9. What is risk-based capital, and how would you use it in financial analysis? Risk-based capital estimates the capital an insurer needs for the risks embedded in its assets, liabilities, and operations. I would examine the company's available capital relative to required capital, then understand the drivers, including investment, insurance, interest rate, and business risk. The ratio helps regulators and management assess solvency, but it is not a complete valuation measure. I would combine it with liquidity, stress testing, earnings quality, and capital deployment plans when evaluating financial strength. Be sure to explain risk-based capital as a capital adequacy framework, discuss asset, insurance, interest rate, and business risks, the ratio concept, regulatory action levels, and management's capital allocation decisions. Question 10. How would you forecast revenue and earnings for an insurer? I would build the forecast from operating drivers rather than applying a simple growth rate. Depending on the segment, those drivers could include premiums, deposits, assets under management, fee rates, investment yields, mortality, morbidity, lapses, claims, and expenses. I would model investment income separately and reflect realistic reserve and capital effects. Then I would create base, upside, and downside cases, testing rates, markets, credit losses, and policyholder behavior to identify the earnings sensitivities that matter most. In your answer, cover premium or fee drivers, assets under management, net investment income, claims and benefits, expenses, persistency, mortality, market assumptions, scenario analysis, and linking operating assumptions to financial statements. Question 11. Describe how you would value an insurance company. I would use multiple perspectives because insurance earnings and capital are highly interconnected. I would examine book value, adjusted book value, earnings, dividend capacity, embedded value where relevant, and segment-specific valuation multiples. A DCF can be useful, but forecasting distributable cash requires assumptions about reserves, capital, spreads, and regulation. I would also assess the investment portfolio and liabilities economically, then compare valuation against peers while adjusting for business mix, growth, risk, and capital strength. Focus on embedded value or book value, earnings and dividend capacity, segment-specific multiples, discounted cash flow limitations, capital requirements, reserve quality, investment portfolio value, and the importance of scenario analysis. Question 12. What are reserves, and how can reserve changes affect earnings? Reserves represent the amount an insurer expects to need for future policyholder benefits, claims, and related obligations. They depend on assumptions such as mortality, morbidity, lapse rates, claim severity, expenses, discount rates, and longevity. If experience improves or assumptions become more favorable, reserves may be released and earnings increase. Adverse development can strengthen reserves and reduce earnings. I would treat reserve changes carefully, distinguishing genuine operating improvement from assumption updates or temporary favorable experience. Make sure to explain reserves as estimated future obligations, assumptions behind them, incurred versus paid claims, releases and strengthening, earnings volatility, reserve adequacy, and the role of actuarial review and governance. Question 13. Tell me about a time you found an error in a financial analysis. During a monthly analysis, I noticed that a variance seemed inconsistent with the underlying volume change. I traced the issue to a formula referencing the prior month's assumptions instead of the current period. I recalculated the affected schedules, quantified the earnings impact, informed my manager promptly, and documented the correction. I then added a review check comparing key formulas across periods. The experience reinforced that good finance work combines technical accuracy, skepticism, clear escalation, and process improvement. While answering, use a concise star structure. Explain the analytical check, quantify the impact, describe how you communicated the issue, and emphasize root cause correction, documentation, and prevention. Question 14. How do you prioritize competing deadlines during a closer reporting cycle? I first map deadlines, dependencies, and materiality, giving priority to regulatory, close critical, and decision-useful deliverables. I break each assignment into inputs, analysis, review, and sign-off, then identify items that could delay other teams. If a conflict remains, I communicate early with a proposed trade-off rather than waiting until the deadline. I preserve review and control steps, use checklists, and escalate risks promptly. Speed matters, but reliable reporting matters more. Be sure to mention materiality, regulatory and management deadlines, dependencies, early communication, task planning, review time, escalation, and maintaining control quality instead of sacrificing accuracy for speed. Question 15. How would you explain a complex financial issue to a non-finance stakeholder? I start with the decision or business impact, then explain the financial mechanics in plain language. For example, instead of leading with duration, I might say that a mismatch between investment timing and customer obligations can create losses when rates move. I use a small example, clearly separate facts from assumptions, and explain the recommended action. Finally, I ask the stakeholder to summarize the takeaway or invite questions, ensuring the communication supports a decision rather than merely displaying technical knowledge. In your answer, Discuss starting with the business implication, avoiding jargon, using a simple example or visual, separating facts from assumptions, confirming understanding, and tailoring detail to the stakeholder's decision. Question 16. What financial controls are important in an insurance finance function? Important controls include reconciliations between policy, investment, actuarial, and general ledger systems, approval of journal entries, validation of source data, segregation of duties, access reviews, and documented valuation and reserve reviews. I would pay particular attention to interfaces because errors can move from operational systems into financial statements unnoticed. Effective controls should have clear ownership, evidence, thresholds, and escalation procedures. I also value monitoring and root cause remediation, since a control that repeatedly identifies the same issue is not fully effective. Focus on account reconciliations, journal entry approval, data validation, actuarial and investment interfaces, valuation controls, segregation of duties, access management, evidence retention, and timely remediation of exceptions. Question 17. How would you assess whether an investment is impaired? I would not conclude impairment from a price decline alone. I would assess the asset's expected cash flows, issuer credit quality, payment performance, collateral, market conditions, and the company's intent and ability to hold it. I would compare modeled recovery value with carrying value and involve investment, accounting, and valuation specialists where appropriate. The conclusion should be documented, consistently applied, and aligned with the applicable accounting framework, because impairment affects both earnings and reported capital. Make sure to cover market value decline, expected cash flows, credit deterioration, intent and ability to hold, duration of loss, issuer fundamentals, valuation evidence, documentation, and the distinction between temporary and permanent impairment. Question 18. How do derivatives and hedging strategies affect an insurer's financial statements? Insurers may use derivatives to manage interest rate, equity, currency, or guarantee risks. Economically, a hedge can reduce exposure, but accounting results depend on instrument valuation, hedge designation, and whether changes flow through earnings or other comprehensive income. I would review collateral, counterparty risk, valuation models, ineffectiveness, and basis risk. A hedge can still create reported volatility if accounting treatment differs from the underlying exposure, so I would explain both the accounting impact and the economic objective. Discuss the economic purpose of hedges, interest rate and equity risks, fair value changes, hedge accounting, collateral, counterparty exposure, ineffectiveness, volatility, and reconciling accounting results with economic risk reduction. Question 19. Describe a time you worked with incomplete or inconsistent data. In one analysis, two source reports contained different totals because their extraction dates and inclusion rules were not aligned. I reconciled the populations, traced differences to the definitions, and confirmed the appropriate source with the data owner. Where information remained unavailable, I used a documented assumption and showed the sensitivity. I communicated the limitation before presenting the conclusion, then proposed a standardized data dictionary and reconciliation step. That approach preserved usefulness without overstating precision. While answering, explain how you identified the data gap, validated sources, made transparent assumptions, assessed materiality, involved owners, documented limitations, and improved the process for future reporting. Question 20. What questions would you ask the hiring manager about this finance role at Prudential? I would ask how success is measured during the first 6 and 12 months, which deliverables are most critical, and how the team partners with actuarial, investments, risk, and business leaders. I would also ask about the largest current finance challenge, opportunities for automation, and how analysts develop technical and commercial judgment. Finally, I would seek clarity on the reporting calendar, team culture, and the types of decisions this role is expected to influence beyond producing accurate numbers. Be sure to ask about success measures, team interfaces, key reporting cycles, major business challenges, technology and automation, development opportunities, and how finance partners with actuarial, investments, risk, and business leadership. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.